Thank you, Daniela. Thank you, everyone, for having me here. And I will try, I'm one of those that is going to talk about a subject that hasn't practiced, which is a perfect point to tell you anything you want to know. So, as a rating agency, we may not operate a bancassurance, but we have seen many bancassurance models. And what I will try to do here is I will try to give you an idea, based on our experience, what has worked and what hasn't worked. So we've seen the examples of Russia and France. I'll try to bring it together from all the markets that we operate. So, yeah, loads of disclaimers. We love disclaimers. Let me go back. Yeah, this one is our process that we evaluate companies. I just put it there so that you will be able to follow what I will be saying. So when we analyze insurance companies, first of all, we start from balance sheet strength. How much capital you have, how much you require, we compare these things. It is pretty obvious. That would be enough if we were looking backwards. The next thing that we look is operating performance. Does the company make profit? How does it make these profits? Is it technical or is it investment? Why is that important? Because that way you build your balance sheet strength of the future. That and investments from your additional investments from your shareholders. The third thing is your business profile. Why? Because companies with clear strategies which identify market opportunities are the ones who can deliver better profits. So that is like building on your operating performance of the future. And the final thing that I will touch here is ERM. This is the one element that enterprise risk management, the one element in this rating analysis that has the ability of making or breaking your company. Exactly because that's what happens in reality. More companies are failing because they have weak ARM than anything else. So with that in mind, let's think a little bit about what drives bancassurance. And I'll jump this one. I will not speak on all of these. I will just pick up a couple of points. On the top left, what is essential? Number 1, 2, and 3, client needs. If there is not a client need, you call it bancassurance, you call it insurance, you call it whatever, it's not going to sell, right? So you need to be covering a need that the clients have. That's exactly what the banks and the assurances in France did all these years ago. The second thing to point out is, out of a bancassurance deal, what happens is essentially the insurance company is borrowing the brand strength of the bank. If you could sell directly, you would sell directly. But the bank, and especially in most of the developing economies, has a much stronger brand recognition than the insurance. And that's what's happening on a high level. In terms of business drivers, I will pick up one, and that is strategy. It is critical, essential, that the bank and the insurance share the same vision about the future. If one needs to make profits for tomorrow, and the other one is talking about profits in 10 years, that's exactly where problems start. The regulatory and legal provisions are significant. I will not go into too many details, but I will tell you, I know regulators which allow banks to have only one insurance partner, and I know other regulator who has regulated all that in the areas that I cover. And I know another regulator which has regulated that a bank needs to have a different distributor for each product they sell, a different, insurer. So depending on that, you have a variation of how you can structure this agreement. And also an interesting point that we often ignore because we assume that all the world has as good data as we find in the really developed economies. So the quality of data and also what ability do you have to share data with organizations that are not your own, this is also something that shapes the profile of the deal. So what after all that, when you put these all together, we have four main types of bancassurance deals. On the top, you have a pure distributor. The bank acts as a distributor of the insurance company. Then you have an exclusive partnership. It can partner with a bank with an insurance. They are separate entities, different owners, but they come together and they sell a range of their products. And they can sell them through their own sales force, or they can have insurance sales force into the entity, into their branches. There's a multitude of subcategorizations. The third one is joint venture. It's what it says. And the fourth one is financial holding, the example that we've seen in France. If you look at it, the bank has the highest control on the bottom of these examples and the least at the top. Now, in terms of complexity, it would seem like, the same thing should be for complexity. So having a pure distributor agreement, that would be the easiest one. What we have seen in practice is this is not the case. And the reason it's not the case is because it's very difficult to have alignment of objectives. What the distributor wants is commission. And what the insurance company wants is probably underwriting profits at some point. And when you put these two things together, it increases the complexity of getting alignment. It increases the complexity of getting things together. And that's important because I would say that if what you're going to sell through your bancassurance is very complex products, then you better simplify your structure. I'm not saying you cannot do complex things on both sides of the equation. They act as a pure distributor selling very complex products. But reality has shown it doesn't really work. So when we look at it, you remember in our starting point, where does it impact on the rating? It impacts on the balance sheet strength and it impacts on the rating lift. What the rating lift means, if you have a financial parent who supports you, that brings your rating up or down. But on the balance sheet, I will touch just on a couple of things. The things that it will impact, number one, on the bottom left, the level of capitalization. What do I mean by that? The example from France. In 20 years, the bancassurance market grew by 16 times. That needs capital. You will be surprised how many insurance companies, forget bancassurers, miss that point. So if it is going to grow, consider if just retained earnings will be enough. Liquidity and asset liability management is also something that is missed in these deals. And the other thing is, depending on the structure, you have issues of fungibility of capital. So if it's one organization versus two separate versus a joint venture, there are different ways that you can put capital in and take capital out. And all these things matter. They matter in the ultimate strength of the entity and effectively in the rating. The next thing that I will touch, we've seen a lot being told about life insurance. If you've seen in France, the main success is life. And In Russia also, it was mostly life. Why is that? Because life insurance products generate more profit. They can be aligned better with the products that the bank sells. So you don't walk into a bank trying to get a mortgage, make a deposit, and someone telling you, well, have you bought travel insurance? It aligns with what you're trying to do. You're trying to buy a house. Have you considered how you're protecting your loan? Have you considered how you protect that house? Life tends to have higher profits. And the one at the bottom, which we've heard again from France, banks do not want to have to deal with claims that they will not reimburse. Even claims that should not be reimbursed, they create trouble and they consider them tarnishing their image, their brand. So for these reasons, in many markets, banks avoid non-life products. Having said that, in many of the emerging markets, where we have conglomerates, where they belong to a family, and the same family owns car distribution, sells cars, owns a bank, and maybe owns an insurance company. The idea of selling motor insurance for the cars that we sell through our distribution is so obvious to them. Or if you get a loan to buy a car, why should we not insure that part of the deal? So, yeah. Again, if we look at the life products, the typical ones, the ones that we see in a lot of the less mature markets is credit life. That is the easiest one to introduce. And I would say it's actually, in many cases, it's not covering a need of the insured, it covers a need of the bank. The bank gives you a mortgage and they want to make sure that if the unfortunate happens and you are not there to pay, someone will pay the residual value. So very typical, decreasing term assurance. It goes with a mortgage and so on. The next thing to introduce, living benefits, critical illness, disability, and then again, often linked with the first category. And then we go into life products, whole of life, endowments, and savings products, annuities. And you will see that, as I said, these are how they're introduced because they are the easier ones to introduce. We are talking about markets where there is not that great insurance awareness, especially about life insurance. So often life insurance is sold like that, almost through the back door. And I would argue that in some of the more mature from a regulatory point of view markets, maybe the regulator would have something to say. You can see the different profitability. I'm not going to go into that one, but consider that many of the banks in this part of the world get into through credit insurance because it's easy to sell and it has pretty decent profits. Now, on the non-life side, what we're seeing is something similar. We see the first ones that are being introduced is credit products, credit-related products, motor, property. You buy a property with a mortgage. With that, you also have the insurance for the property. Not only for the loan, but for the actual asset. We are seeing commercial risks. Why would you see commercial risks? Again, because you have the conglomerates. So the owner of the ultimate deal has some other risks that they want to insure from his other companies. And that could also go through the bancassurance. And in many cases, we see standalone products, standalone non-life, motor, property, and so on, which again, it shows you that some banks are moving way out of their norm, but that's very limited. And typical profitability in all these things is reducing. The more you get these products into the open market, the more that people, especially for non-life, get price sensitive, especially when you sell something like motor, which is a utility product. So when you look at the areas that it operates, it's operating performance. How much profit you make? How will you make it? Typically in bancassurance, we get better profitability than normal. Business profile. Now think of it. If you are one of these banks or bancassurers who are growing by 16 times in 20 years, when the whole market, the rest of the market, is actually growing by 2-3%. That strengthens your position. So all in all, these are the three areas that you will see successful bancassurers doing better. Yeah, it will impact the underwriting performance and the operating earnings. I do not want to, for the benefit of the time, I do not want to go through the details. Some of them are very obvious, like I said, about the market position that you have by growing much faster and so on. The one thing I will touch and I will leave on this one is about ERM, because often these deals are put together by salespeople. Those strategies are the best. And often ERM is something that is not given enough thought. So when that is happening, it's good to think not just on the product risk, the fact that you as a bancassurer or as an insurer are writing some extra products through a new channel. The one thing that quite often is missed out is the operational risk. You're adding complexity in an organization that already has its own. And often that is misunderstood, miscalculated. So I hope I gave you a very quick and clear idea of what we are seeing in terms of bancassurance. I will finish here on the benefit of not running too late, and I will thank you for your time.